Let's talk to Craig Erlam. He's Senior Market Analyst for Oanda. Very good morning to you, young Craig.
Good morning.
Right, we're going to go off the beaten track this morning. You've sent a chart of the euro against the Japanese yen. Why on earth are we looking at this currency pair this morning?
Well, I mean, I'm sure you spent plenty of time talking about some of the more mainstream pairs, and to be quite honest, you're looking at things like euro dollar, pound dollar. It's not quite as interesting as some of these other pairs, so these alternative pairs may not spring to mind as quickly, but you take a look at this chart and you can see that there is a lot still going on.
Yep.
It looks more complicated than it is, so don't be scared by the number of lines and everything that's on here. You've got straightforward...
People are critical of technical analysis in trying to overcomplicate it. Are you a great advocate of keeping it simple, or...?
You wouldn't guess it by the looks of this screen, but typically I am. I think you've just got to take everything with a bit of context, and if there's a reason for things being there and things align together well, then I don't think there's any serious problem with it. For example, the cloud running through this is an Ichimoku cloud. I use it on my yen pairs because it's widely used in Japan, particularly when trading yen currencies. So there's always a little bit of information that can be gathered from that.
Okay.
And you can see that during the rise, going back to the start of the chart until now, we kept coming into this cloud and rebounding out. So this was signs that the uptrend was still strong, that there was still more buying interest and selling interest.
So in terms of the Ichimoku, if you're trading above it, it tends to be bullish, and below it, bearish. And
exactly.
It acts as support and resistance. So people shouldn't be too scared of the terminology.
People hear Ichimoku cloud, they see all the numbers, they see that it's not a typical thing you find on your chart. They become wary of it and they think it's overly complicated. But it's actually extremely simple. It's just as simple as a moving average.
Okay.
It's actually an adaptation of a moving average, effectively. I also have a couple of moving average bands on there as well, just simply because I use them on all my charts. And again, in this particular case, you can see they aligned quite well with the Ichimoku cloud and provided support on the way up. And you can see recently the 200 and 233 has provided support on the way down.
So the 200 period moving average being a key barometer, if you like, for fund managers and the likes.
200-day moving average is probably the most commonly used moving average out there. I also use some Fibonacci moving averages, just because you'll notice with my charts I use a lot of Fibonacci. I think it seems to sit well on
But why
charts.
do Fibonacci levels work?
It's hard to say, really. I mean, there's those who will suggest...
They're natural numbers, aren't they?
They're natural numbers. They work in everyday life, apparently. Yeah. I think there is probably a self-fulfilling aspect of them in the markets, where enough people are using them, then they do tend to work quite well. And that's why with for example, the Fibonacci retracement levels, you can sometimes see it hit that 50%, 61.8%, 38.2%, and you'll see a very clean rebound. And that would suggest that a lot of people are looking at that level just because everyone's using it. So therefore, it has this self-fulfilling aspect. But the thing that I like about, for example, Fibonacci retracement levels is they coincide a lot with Dow theory as well, the retracements of around a third or a half or two-thirds, which roughly coincides with Fibonacci as well.
And that is a theory that dates back over 100 years, right?
And that's a theory that was spotted not because someone decided that this is a good idea, but they were looking back at charts and they noticed that whenever you see retracements in markets, they tend to retrace roughly around a third, a half or two-thirds.
Okay.
So it does coincide nicely with the fibs. Now, again, the fibs aren't a given rule. It's not saying if it hits here, sell. If it hits here, buy. But you're looking for areas where they coincide nicely with other potential support and resistance levels. And as we can see on this chart here, we had this low from around the end of September right through till only a couple of weeks ago, around 131.50, 132. And that just falls below the 38.2 Fibonacci level. We are finding resistance here at the moment, so there's a possible, not a guaranteed, a possible rotation point if in fact this market is bearish, as the signs would currently suggest they are. We're below the cloud, we're breaking moving averages, that's bearish signals. So you're looking for possible rotation points lower, and this could be one. I would personally like to see a move back towards the kind of 133.50, 134 levels, because around here you start to hit the Ichimoku cloud again from below. Here you're looking for confirmation of that initial break. The 55.89 moving averages coincide very nicely with the cloud at this point, and you're also hitting key fib levels and prior levels of resistance again from that September-December period. So you can see where I'm going here. We're taking a number of different indicators that work quite well together, provide different information so they're not conflicting, but they all point to two big levels that we're looking at right now: 130, 150, 132 area, and the 134, 134.50 area. And these are the two which I think are going to be extremely key. And if we are going to see a bearish move, then it'd be interesting to see if they come off these levels.
Okay, that was a very good guide to technical analysis. And the fundamentals, any headlines we should be aware of on this currency pair?
Needless to say, it's a big week for fundamentals. We've got ECB tomorrow. I don't expect a dramatic change, but markets don't tend to necessarily always respond to dramatic changes. They respond to small changes. So what we're expecting from the ECB tomorrow, for example, is that they will slightly adapt their language. So rather than say that they're open to extending their asset purchases, if need be, they're looking to remove that. This may sound like nothing, and in reality it is nothing. If the economy falls into recession, that's not to say they won't increase their asset purchases in order to respond to it. But what it says is it sends a message that they are becoming increasingly confident that inflation is becoming more improved, it's moving more towards target, it's becoming more sustainable, so they are looking for a prolonged exit from the stimulus program, whether that be September with an outright jump from 30 to 0, or whether it will take out till December. It's irrelevant. It shows that they are headed towards that direction.
Yep.
They're giving plenty of notice. So that's the one thing, small thing that we are looking for from tomorrow's meeting. But we've still got the Italian election result that provides a lot of political uncertainty. We've had the German election result, which provided a little bit of upside at the start of trading on Monday, which was overshadowed again by Italy. When you're dealing with the yen, you're looking at safe haven trades. The North Korea thing yesterday was a boost for risk appetite.
Yep.
So that was negative for the yen. But there's also a lot going on with Trump and tariffs as well.
Sure.
So a lot of these things do fill into it. It makes it more interesting. It provides volatility, which is what we need. But as far as the rest of the week's concerned, keep an eye on that ECB meeting. I will expect a lot of volatility around it.
Craig, on that note, thank you very much indeed.